If you started investing just $5 a day at age 25, you'd potentially have over $1.1 million by retirement, assuming an 8% annual return. But here's the stark reality. 78% of Americans never achieve this level of financial freedom because they chase short-term gains or avoid investing altogether. This common mistake costs them an average of $683,000 in lost wealth compared to those who consistently invest. Today, we're unlocking the secrets of the world's most successful investor, Warren Buffett, and showing you how his practical, long-term approach can prevent you from making these costly errors. He doesn't just pick stocks, he buys businesses, a philosophy that has built unparalleled wealth over decades. Warren Buffett isn't interested in hot trends or speculative ventures. He's a value investor. This means he looks for companies trading for less than their true underlying worth, their intrinsic value. Instead of following the crowd, Buffett and his partner Charlie Munger focus on fundamental business strength. They seek out businesses that are understandable, financially sound, and possess durable competitive advantages. This patient, disciplined strategy has allowed Berkshire Hathaway to generate an average annual return of over 20% for its shareholders from 1965 to 2022, turning modest initial investments into generational wealth. It's about thinking like a business owner, not a stock trader. Buffett's first crucial step is to invest only within his circle of competence. This means he buys businesses he truly understands. If he can't explain how a company makes money or what makes it special, he won't invest. For decades, this led him to largely avoid technology companies because he felt he didn't grasp their rapidly changing dynamics. This disciplined approach prevented him from making speculative bets on companies outside his expertise, saving him from countless potential losses that others might incur by chasing every new fad. It's about humility and self-awareness in your investment choices, a trait often overlooked. A great example of the circle of competence in action is Apple. For years, Buffett avoided tech. But by 2016, his understanding of Apple had evolved. He didn't view it as a tech gadget company, but rather as a consumer goods company with an incredibly strong brand ecosystem, loyal customers, and predictable revenue streams from services. This shift in perspective, seeing Apple more like a utility or a consumer staple, brought it within his analytical framework. Berkshire Hathaway invested billions, and Apple quickly became their largest holding, demonstrating that the circle can expand, but only with deep, evolving understanding. For you, applying the circle of competence means sticking to industries or companies you genuinely understand. If you work in healthcare, perhaps you have an edge identifying strong healthcare companies. If you're a teacher, you might recognize value in educational technology firms or textbook publishers that others overlook. Don't feel pressured to invest in the latest cryptocurrency or AI stock if you can't articulate its fundamental business model and competitive advantage in simple terms. Prioritize industries where you have an informational edge or a deep, intuitive grasp, even if it's just from being a discerning customer. Next, Buffett seeks businesses with a strong economic moat. Think of a moat around a castle. It protects the castle from invaders. In business, an economic moat protects a company's profits and market share from competitors. These moats are durable competitive advantages that allow a company to consistently earn high returns on capital over a long period. Without a moat, even a good business can be easily disrupted by new entrants, leading to declining profits and an eroding investment. Buffett famously stated, "The most important thing for me is the moat." There are several types of economic moats. One is brand strength, like Coca-Cola's unparalleled global recognition, allowing it to charge premium prices. Another is cost advantage, where a company can produce goods or services cheaper than anyone else, making it tough for competitors. Network effects, like those seen in credit card companies such as American Express or platforms like Google, become more valuable as more people use them. Switching costs, where it's expensive or inconvenient for customers to change providers, also create a powerful moat. Identify which moat protects a business before you invest. Consider See's Candies, a relatively small acquisition for Berkshire Hathaway in 1972. It wasn't about rapid growth, but its incredibly strong brand and customer loyalty in California. See's had pricing power, meaning they could raise prices slightly each year without losing customers, a testament to their brand moat. This seemingly simple candy company generated substantial cash flow for Berkshire Hathaway for decades, proving that a durable moat, even in a non-tech industry, can be an incredible asset. Buffett learned invaluable lessons from C's that he applied to larger acquisitions. For your own investments, look beyond just revenue growth. Ask yourself, what protects this company from competition? Does it have a unique product, a dominant brand, or a cost structure that others can't match? For example, a local restaurant might have fantastic food, but can another one easily open next door and compete? Probably. A software company with proprietary technology and a massive network of users, however, will be much harder to dislodge. Focusing on moats means seeking out companies that have sustainable advantages, not just temporary fads that will quickly fade. Buffett places immense value on strong, ethical, and competent management. He often says he'd rather invest in a good business with fair management than a fair business with great management. He looks for managers who act like owners, are transparent, and allocate capital wisely. He's famously hands-off with his acquired companies, allowing the existing management teams to continue running their businesses, precisely because he trusts their character and capabilities. This approach minimizes interference and maximizes the potential for long-term growth driven by those who know the business best. A prime example is Ajit Jain, who leads Berkshire Hathaway's massive reinsurance operations. Buffett has publicly praised Jain countless times, describing him as a superstar and irreplaceable. Jain's ability to understand complex risks, price policies shrewdly, and adapt to changing market conditions has made Berkshire's insurance arm a consistent cash cow, generating billions for the conglomerate. Buffett gave Jain a simple directive: don't lose money, and Jain delivered, demonstrating the profound impact of exceptional leadership on business success and investor returns. When evaluating management, look for leaders who prioritize shareholder value, not just their own compensation. Read annual reports and shareholder letters to understand their philosophy. Do they communicate honestly about challenges or only boast about successes? Are they investing profits back into the business wisely or engaging in wasteful expenditures? Pay attention to executive compensation structures. Do they align with long-term performance? A management team that consistently makes smart capital allocation decisions is a powerful indicator of a company worth owning for the long haul. Once Buffett identifies a quality business with a moat and great management, he determines its intrinsic value. This is the true worth of the business, independent of its fluctuating stock price. He then applies a margin of safety. This means buying the stock only when its market price is significantly asterisk below his calculated intrinsic value. Think of it like buying a $10 bill for $5. The margin of safety protects against unforeseen business setbacks, errors in your valuation, or general market volatility. It's the cornerstone of true value investing. A famous example of Buffett using the margin of safety was during the American Express salad oil scandal of 1963. American Express had lent money to a fraudulent company, causing its stock price to plummet by over 50% as investors panicked. Buffett didn't panic. He understood the core American Express brand, and its travelers' checks business were sound and would recover. He calculated its intrinsic value remained high and invested heavily, buying $20 million worth of stock when the market was terrified. Within a few years, the stock rebounded, turning his investment into an enormous profit. He bought quality when it was on sale. To apply margin of safety, learn basic valuation techniques. You don't need to be a Wall Street analyst. Start by looking at a company's earnings, revenue growth, debt levels, and cash flow. Compare its price-to-earnings, PE ratio, to its historical average and to competitors. If a fundamentally strong company with a moat is trading at a historically low PE or has recently suffered a temporary setback that depresses its price, that might be your opportunity to buy with a margin of safety. Remember, be fearful when others are greedy, and greedy when others are fearful. Finally, Buffett is a master of the long game. He famously said, "Our favorite holding period is forever." He's not buying stocks to flip them next quarter. He's buying to own a piece of a business for decades. This allows the magic of compound interest to work its wonders. By holding great companies, dividends are reinvested and profits compound over time, leading to exponential growth. Constantly buying and selling stocks triggers transaction fees and taxes, eroding returns, whereas patient holding maximizes the power of compounding. Consider Coca-Cola. Berkshire Hathaway made its initial massive investment in the late 1980s. Buffett didn't just buy the stock. He bought a stake in a global powerhouse with an unshakable brand moat. Over the subsequent decades, Coke's dividends have flowed into Berkshire's coffers, and the stock price has appreciated significantly, even if it hasn't always been a straight line up. This long-term commitment allowed Berkshire to benefit not just from price appreciation, but from consistently growing dividend income that could be reinvested elsewhere, further accelerating wealth creation through compounding. For you, the actionable advice is simple but hard. Cultivate patience. Once you've done your research and identified a great business at a fair price, don't constantly check its stock price. Focus on the business's fundamentals. Is it still performing well? Is its moat intact? Is management still competent? If the answers are yes, resist the urge to sell due to short-term market fluctuations. Reinvest any dividends you receive to supercharge your compounding. Think in terms of years and decades, not days or weeks. This discipline is often what separates successful long-term investors from short-term speculators. So let's recap Buffett's simplified framework. First, understand what you're buying, circle of competence. Second, ensure the business has a durable competitive advantage, economic moat. Third, trust the people running it, great management. Fourth, buy it only when it's undervalued, intrinsic value with a margin of safety. And finally, hold it for the long term, allowing compounding to work its magic long-term horizon. These 5 pillars aren't complex theories. They are practical, time-tested principles that have proven effective for over half a century. You don't need a finance degree or millions of dollars to start investing like Buffett. You need discipline, patience, and a willingness to do your homework. Begin by looking at companies in industries you understand. Research their competitive advantages and analyze their financial health. Don't be afraid to take your time and wait for a great business to go on sale. Even investing in a broad market index fund, which Buffett himself recommends for most people, aligns with his long-term, low-cost philosophy, providing an excellent foundation for any investor. Implementing these principles in your own life won't make you a billionaire overnight, but it will significantly increase your chances of achieving true financial independence. It's about building wealth steadily, sustainably, and intelligently. Remember, the biggest returns often come from simply staying invested in quality assets and avoiding emotional, short-sighted decisions. Your financial future is not determined by market gurus or hot stock tips, but by your own consistent, rational choices. Start applying Buffett's wisdom today, even in small ways, and watch your wealth grow.